Okay, so if you follow any news or happen to overhear finance bros talking about finance, you have probably heard the term Fed rate cuts and Fed rate hikes. But do you have any idea what those actually mean or how it could affect you? I'm going to explain it to you in everyday language right now so that you can know what's going on and maybe even break it out at your next happy hour. This is Rich Girl's Guide, where we demystify the world of personal finance to help you create a financially successful and fulfilling life. I'm your host, Kirby Delicano, and I worked in wealth management for over 6 years before leaving the office to focus on my business and my family. Okay, so let's start with the basics. What is the Federal Reserve? The Federal Reserve was created back in 1913 to help stabilize the US economy and make key decisions regarding monetary policy. Before the Great Depression, we actually had a financial panic back in 1907 that led to many banks failing, the stock market crashed, and pretty much every failing bank had to turn to private funding or close their doors for good. Because of this, the Federal Reserve Act was created in 1903 that effectively created what we now refer to as the Fed. In very general terms, they are tasked with 3 main objectives at any point in time: keeping employment high, keeping interest rates at a moderate level, and not letting inflation get out of control. The Fed is made up of 3 main entities. First, we have the 12 Federal Reserve banks that are located all across the US. These banks mainly oversee local banks to ensure they are following the law and to help with liquidity. In a nutshell, they are ensuring banks don't run out of money, which in turn could cause a huge panic. Can you imagine if someone walked up to their local bank and was told that their branch was out of cash at the moment, but why don't they try the bank down the street to see if they have any cash? Yeah, I think TikTok would basically erupt with an influx of videos of people trying to withdraw their money while they still can. So yeah, they are definitely trying to avoid that kind of mass public fear by making sure banks are following the rules and have enough cash on hand for their customers. Next, we have the Board of Governors, which is made up of 7 individuals who oversee the 12 Federal Reserve banks. Think of them as like the CEO and executive team of the whole Federal Reserve. They are tasked with making sure the Fed is acting in alignment with the goals and responsibilities that are mapped out in the Federal Reserve Act of 1913. While also overseeing the 12 Federal Reserve banks. Finally, we have the Federal Open Market Committee, also referred to as the FOMC. The FOMC is made up of 12 individuals, the 7 members of the Federal Reserve Board, i.e. the CEO and the executive team, the president of the Federal Reserve Bank of New York, and 4 other Federal Reserve Bank presidents that rotate out on an annual basis. You can kind of think of the FOMC as the board of directors for the Fed, while the CEO and executive committee are making sure that the 12 banks are doing what they need to be doing and that their actions are in alignment with their goals. The FOMC is actually setting those goals and enacting monetary policy. Currently, the chair of the Federal Reserve is Jerome Powell, a name you have probably heard in conjunction with Fed rate cuts. He is the top dog in the Board of Governors, think CEO, which means he is also top dog in the FOMC. Remember, all 7 members of the Board of Governors are also members of the FOMC. He effectively runs the FOMC meetings that are held 8 times a year, and his position is one that is appointed by the President of the United States. Jay is the person who gets up in front of Congress twice a year to report on the state of the US economy and answers questions from Congress. We're going to circle back around to this at the end of the episode because he just testified in front of Congress a few weeks back in July, and you are definitely going to be interested in what he had to say. Now, the Federal Open Market Committee is usually what most people are referring to when they say the Fed is cutting rates. And that's because the FOMC meets 8 times a year to make decisions regarding monetary policy, aka setting interest rates amongst the banks. Now, why does setting interest rates amongst the banks affect interest rates for the rest of us? Essentially, every single business day, banks have to shuffle cash around amongst themselves to ensure that they have enough cash on hand to deal with customers the next day. If one bank, Bank A, does not have enough cash, they can reach out to Bank B to essentially borrow their cash. But these are banks, and they don't loan out cash for free. Instead, they have to use the federal funds rate. The federal funds rate is an interest rate that is set in stone by the Fed. Currently, the rate is sitting at 5.2 to 5.5%. Because the banks are required to use this federal funds rate, whatever the rate is tends to be the floor of what they use with the general public, aka you and I. Let's look at the picture a little more broadly. If a bank is loaning out money to another bank at a rate of 5.5% and paying a rate of 5.5% to borrow money from another bank, they are most likely going to be strapped into charging at least 5.5 interest rate to customers that are looking for loans. That is one of the reasons why you tend to see mortgage rates and car loans at a rate that is slightly higher than whatever the federal funds rate currently is, at least for those of us with a good credit score. The bank still needs to make money. Remember, they are a business, and it wouldn't be great business to be handing out loans at a rate that is lower than the rate they are being charged. Especially because, as we all know, they're definitely not getting paid back 100% of the loans that they do give out. So, taking that into account, let's look at average interest rates for mortgages compared to the Fed funds rate over the past 30 years. If you are watching on YouTube or Spotify, then you can clearly see that the Fed funds rates and the average mortgage rates are directly correlated, with mortgage rates ranging anywhere from 1% to 5% higher than the Fed funds rate. When the Fed hikes rates, aka raises rates higher, the mortgage rates in turn average higher. When the Fed cuts rates, aka decreases the rate that banks lend to each other, then mortgage rates fall. Now, one thing that I very rarely see mentioned in the same conversation as mortgage rates is the fact that CDs, certificates of deposits, and other short-term investments are also directly correlated with the Fed funds rate. For younger savers and investors, think of your high yield savings account. That annual interest rate you get, the APR, is directly affected by the Fed raising and lowering rates. So while everyone tends to complain when the Fed is raising rates that mortgage rates will go up and car loans will go up, I don't hear anyone complaining about the fact that they are getting more interest on their savings. Now, maybe those people aren't utilizing high yield savings accounts or CDs or treasury notes, but even so, if you are invested in any kind of well-diversified mutual fund or money market fund within your retirement account, you will also see a slight bump there, unless you are 100% invested in individual stocks, in which case, best of luck to you. Now, obviously, the opposite of this is also true. When the Fed cuts rates, loan rates will also drop, albeit not instantaneously. And your high yield savings and CD rates are also going to drop, meaning you are earning less on your short-term and cash savings. So, what does this mean for your bottom line? As I have hopefully drilled into your head by now, it's a bit of a give and take, and a rate cut could either be great for you, detrimental, or completely neutral. It all depends on your current life circumstances. If you are a first-time home buyer and have been hoping to get a lower rate than the current average of 7.5%, then a rate cut might be music to your ears. The lower the mortgage rate, the lower your monthly payment will be, which means you might be able to afford a more expensive house or be able to save more each month for future goals. On the flip side, if someone bought a house in 2020 and has one of those coveted 2 to 3% interest rates, they are probably not looking to move anytime soon, so they don't necessarily care what the current mortgage rates are. They might be prioritizing their savings for a future car purchase or future babies that are on the horizon, in which case they might actually want the higher interest rates so that they can make more money on the cash they are socking away. So it's not necessarily a one-size-fits-all when it comes to rate hikes or cuts. Your situation and life circumstances will dictate whether or not it's a good or a bad thing. It also might be completely neutral for you. If you rent or own your home outright and are not looking for a loan of any kind in the near future, you don't keep any cash in short-term savings or investments, and your long-term investments are growth focused, this is really not going to affect your pockets whatsoever. Now, what may affect you is what a rate cut or hike will do to the economy, but I'm gonna table that discussion for another day because that is opening up a whole nother can of worms. All right, let's circle back around to the recent Fed meeting that happened at the end of July and what Jay Powell testified to Congress in early July. Jay testified that the US economy was cooling off and getting somewhat back to normal, which is usually code for an upcoming rate cut. According to an article posted in Reuters on July 9th, quote, the US is no longer an overheated economy, with a job market that has cooled from its pandemic era extremes and in many ways is back where it was before the health crisis, Fed Chair Jerome Powell said in remarks to Congress that suggested the case for interest rate cuts is becoming stronger, end quote. This is even more true now, as the recent jobs report that came out earlier this month showed an increase in unemployment, currently sitting at 4.3%. Yet another indicator that the economy is getting somewhat back to normal. Now, a few weeks after Jay said all of this in Congress, the Fed had a meeting, which of course included discussions about whether or not a rate cut would be on the table. The Wall Street Journal reported, quote, Federal Reserve Chair Jerome Powell said officials could cut interest rates at their meeting in September, moving closer to a new phase that seeks to avoid weakness in the labor market in the midst of signs inflation is heading lower. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate, Powell said. A reduction in the policy rate could be on the table as soon as the next meeting in September, end quote. So, given this, plus the recent jump in unemployment, I think it is pretty safe to say we will see a rate cut in September, probably a 1/4 or 0.5% cut, as the Fed tends to cut rates slowly over time, but honestly, we'll just have to see. Let me know what you think in the comments. Do you think a rate cut is inevitable? Do you pay attention to this kind of financial news, or do you typically tune it out? Thank you so much for tuning in to today's episode. I will have a brand new episode out on Monday. Till then, have a wonderful week. Later, rich girls.